Welcome to the January update from Cardinal Capital Management. Rates for Guaranteed Investment Certificates, or GICs, haven't been this high since the mid-90s. It's easy to find a one-year GIC that pays nearly 6% today, a rate that's hard to ignore. But investors shouldn't expect this phenomenon to last for long. A lot of lenders are offering 2- and 3-year GICs at lower rates than one-year versions, creating an inverted yield curve. It's uncommon to see long-term rates lower than short-term rates because investors are traditionally rewarded with higher rates for longer-term investments. Inverted yield curves signal that interest rates are expected to fall in the future. After several years of rate increases, we believe we are finally near a tipping point. A 6-year GIC looks enticing, but GICs are unique investments. Your money is locked in for 1, 2, 3, 5, or 10 years. Upon maturity, investors have reinvestment risk, as they may not be able to reinvest at the same rate they just earned. Here's an example of reinvestment risk. If you had put $100,000 in a rolling 5-year GIC in 2009, you'd make just $2,200 per year by 2023. That's a far cry from the $14,200 you'd earn annually from our Canadian equity portfolio. GICs offer capital protection and income for those with a short and medium-term time horizon. For example, if you plan to buy a car in 12 months, it makes a lot of sense to park your savings in a 1-year GIC. But for money you don't need for 3 years or longer, dividend-paying stocks can potentially get you higher income and a higher return. Dividend-paying and dividend-growing stocks can beat that 6% GIC yield over the long term. Here's the proof. On that same initial investment of $100,000 in 2009, our Canadian equity portfolio is now yielding a healthy 14.2% on the invested capital. And finally, investing in a Cardinal portfolio of dividend-growing stocks ensures your income stream is inflation protected over the long run. And why do we do all this? Because it works. That's our January update. Thanks for joining us.